Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host, as always, David Kaufman, president of Westport Capital. This is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we'll take a look at how macroeconomic factors impact your alternative investments. How could Europe's debt problems, for example, trickle down into your portfolio? We'll also discuss what investment opportunities there are right now as a result of so much global uncertainty. Great to see you, David.
Good to be here, as always.
All right, so the topic is macroeconomics, but we need to understand microeconomics as well to understand the macro part of it, right?
Yeah, to be able to measure them relatively. So let's start with a definition of microeconomics. And so what we have here is that microeconomics is the study of decisions that people and businesses make regarding the allocation of resources and prices of goods and services. So let's say you're a microeconomic analyst. What sorts of things are you going to look at? What elements? You're going to look at things like regional supply and demand drivers. What are going to be the price of the inputs and the outputs? How about competition? So what market share am I going to try and grab, and what strategy am I going to use to grab it? And things like procuring financing and cost management. How much will I pay, and from whom will I get my money that I'm going to have to borrow? And also, will my suppliers play a role in financing my operations?
All right. So the topic of the show is macroeconomics. That's the micro side. Explain macroeconomics.
And I think we also have a definition of macroeconomics. So macroeconomics is the field of economics that studies the behavior of the economy as a whole, not just of specific companies, but entire industries and other related economies. So now we're talking big picture. So if I were a macroeconomic analyst, what would I be looking at? I'd be looking at things like gross domestic product, how much an entire nation produces, unemployment, which of course can affect things, of course, like demand, interest rates and inflation, because that affects the cost of capital and, of course, the price that I might be able to achieve when I sell a good or service. And foreign currency variables are very important as well, because especially in Canada, where we have net importers and exporters, foreign currency matters a great deal.
All right, David, so how does all that affect alternative investing then?
Well, the best way to talk about this is, I think, to use an example. So I've put together a hypothetical example of someone in Ontario who is running a private office REIT. So it's alternative because it's private, and it's alternative because it's a REIT, which is a real estate investment. So on a microeconomic level, so this is an office REIT, we care about things like the location of the office buildings. Are the markets good or bad? The cap rates and the financing availability. How much am I going to have to pay for these buildings, and how much rent will I be able to extract from them? And competitive advantages. Am I going to have a call center? Will I have centralized management? Will I have a special relationship with anchor tenants? And these are micro drivers of how my performance will end up reflecting those elements.
Right. So then an investor in a private office REIT would have to deal with the macro side too. Yeah.
And on the macro level, we're going to look at things, as we just mentioned, like interest rates. How much am I going to have to pay to borrow once I've established a relationship with a lender? Inflation. I want to know where inflation is going, because it'll tell me how much I can increase the rents over time. GDP growth, of course, would affect me as an office REIT, because more GDP growth would imply that there would be more people looking for office space. And, of course, then you have the good old investor confidence, risk off, risk on, which is the question of, at different times in the economic cycle, investors in my REIT might want to either invest with me for a nice stream of cash flow, or they might want to go elsewhere and seek higher returns.
All right, David, that was great as always. But as always, we have a specialist to talk about this topic. So we'll turn to him in just a second. Coming up, we'll discuss what effects interest rates and inflation and many other topics have on your alternative investment portfolio. Again, we're talking about macroeconomics. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westport Capital. This week, the topic is but primarily macroeconomic factors influencing your alternative investment portfolio. And joining us this week is Stephen Johnston. He's partner with AGCAPITA Partners and PetroCapita Income Trust. He joins us from Calgary. Thanks a lot for joining us today, Stephen.
Well, thanks for having me. It's my pleasure.
Now, I understand you have a lot of experience globally, and I'm just wondering how your training and that experience has informed your view of macroeconomics.
Yeah, before I came back to Calgary to manage money, I actually was in charge of emerging market investing for Societe Generale based in London. And as most of your viewers will probably be aware, that small emerging market economies are really driven by macroeconomic factors, current account surpluses, currency fluctuations, and GDP growth. Those tend to be your key return drivers, and so we really, as an investment manager, really have a top-down focus when I'm looking at investments.
Now, Stevens, taking a top-down approach, you could have top-down talking about, for example, sectors of the U.S. economy, but today I think we're going to take a truly top-down approach, like from the space shuttle, of the entire globe. Isn't that right?
I certainly think we should try. I think it's a worthwhile exercise, given that we live in very, very unusual times, certainly in the financial sector.
Now, Stephen, we're looking at very low interest rates. How do they affect investments? Where are they now? Where are they going? What do you think?
Well, I mean, obviously we have historically low interest rates, and unfortunately I would argue that those historically low interest rates are a completely artificial fabrication of central bank intervention in the bond markets. And so unless central banks are willing to continue that intervention indefinitely, and certainly they indicate they're willing to do it for an extended period, then at some point we have to face the fact that we're going to return to much more normal rates of interest, and that kind of interest rate is not going to be 3% 10-year rates. We're looking at much more like 5 or 6% long-term lending rates, which are much more in line with historical averages. So I think if you're looking at 5 or 10 years and you're making investment decisions, you should certainly factor in that you shouldn't expect this low interest rate environment to continue indefinitely.
Now, Stephen, using my example as someone who's operating the office REIT in Ontario, how the central banks act around the world affect them, for example, with their cost of capital over the long run?
Well, I mean, you pick on a sector which is extremely interest rate sensitive, of course, commercial real estate in particular, because the large amounts of leverage that investors use in that asset class. So, of course, it has a very high sensitivity to interest rates. If I was a real estate investor now, I'd be thinking about locking in long-term financing at these low levels, and of course, and then shortening the duration on your lease portfolio. I think that when we were talking earlier, and a guest previously had said that the ideal scenario to be in now as a landlord is to have short-term leases and long-term debt financing. I couldn't agree more.
Stephen, what do low interest rates mean for commodities?
Well, of course, I mean, in fact, we have negative real interest rates right now. So if you take the nominal headline interest rate and subtract inflation, interest rates are negative. Commodities always flourish in negative interest rate environments. And we've actually, you've seen that effect take place over the last 3 years. We have all-time nominal highs in the CRB spot commodity index, even after the financial crisis. Commodities are reflecting these extremely low interest rates, and as long as real interest rates are negative, I would expect the commodity bull market to continue.
Now, Stephen, commodities is a big word. So when you say that you expect the commodity bull market to continue, are you referring across the board from precious metals all the way to grains and others?
Yeah, I mean, I really, when you think about the commodity complex, you can have two drivers. You can have inflation, like nominal interest rates, and you can have real demand changes. And I think actually what we're seeing now in the commodity space is actually both of those drivers are in the favor of higher prices. You have extremely expansionary monetary policies by all the central banks, which is driving up commodity prices in nominal terms. But what you're also seeing is actually real step change increases in demand, and it's no surprise, and certainly I don't think it's particularly revolutionary insight that we're seeing a lot of incremental demand come out of the emerging economies as they become middle class. And so we have both the drivers, inflationary monetary policy and real demand increases driving commodity prices up. So, although no trend goes up in a linear fashion, certainly as an investment team, our expectation is that we would expect to see continued increases in commodity prices over the next decade.
Stephen, there are those who expect not just inflation in the years to come, but hyperinflation, especially gold bulls. Do you buy into that theory at all?
Well, we live in fairly extraordinary times, so you always have to be careful what you say about the future. I mean, if someone had asked me 3 years ago, would have I expected the U.S. Federal Reserve to increase the base money supply 200%, I would have said, no, that will never happen. So with that caveat, hyperinflation is a political decision. Hyperinflation takes place in countries where the central bank decides unequivocally to monetize government fiscal deficits. I don't know that we've reached that point yet in the developed world, but we certainly have all the preconditions in place for a sustained bout of very high inflation, and commodities are starting to reflect those conditions. I would certainly believe, if you look at the money supply increases, that that should be followed by a commensurately large increase in the rates of inflation. Certainly, if you think that's a risk, then you should be looking at precious metals as a way to hedge that.
And Stephen, we know that interest rates, of course, are at an all-time low, and they can really only go up from here. But as we look around the world at Greece and Portugal, Ireland, Italy, and certainly the U.S. as well, which is right now under extreme stress to try and get something done before their so-called deadline, how do the decisions that they make now, how are they likely to affect investors now and going into the mid and the long term?
Well, we're certainly heading into a period where the solvency of sovereign borrowers is being called into question. I mean, we just came through a very benign interest rate environment of 15 years where governments, countries could run fiscal deficits almost without limit. There was no hesitation in the bond markets to fund government deficits. Now, of course, the private sector lenders are saying, you know, we're starting to question whether a year after year of fiscal deficits is a sustainable policy. And I would say that this really isn't an ideological decision. You're seeing, you know, the left and the right in the United States fight it out over the debt ceiling. It's really a mathematical question. You cannot indefinitely receive $1 of benefits from the government for less than $1 of payments. At some point in time, you have to pay the piper, whether that's through taxes, whether that's through austerity, whether it's through inflation, or whether it's through a default. And I think that unfortunate dynamic is starting to be played out in a lot of countries who have basically reached the limit of their borrowing capability. And that you're seeing that in Greece, you're starting to see that in Italy, you're starting to see that in Spain.
Okay, now Stephen, let's bring that back to the U.S. for a second, because if I were a Republican, you would have just touched the third rail of Republican politics by saying that one way to approach it is through revenues or taxes. Are the Republicans being overly dogmatic by saying no new taxes, we're going to have to do this strictly through cuts?
You know, I'm reluctant to delve into an ideological discussion, but I would say that there are enormous deficits that have to be paid. There's no short-term way to reduce the deficit in the United States without massive cutbacks in the size of government. So I would argue that it's an unrealistic expectation over the next 12, 24 months that those cuts are possible. So I think that some sort of compromise on the debt ceiling is unfortunately going to be required, but what I hope doesn't happen is that an increase in the debt ceiling is seen as a way to postpone getting the U.S. fiscal house in order. And even, you know, Ben Bernanke, the chairman of the Federal Reserve, has said the biggest issue facing the world's financial markets is the U.S. fiscal deficit. And the U.S. government, as the largest borrower in the world, cannot continue on this path. Something has to be done about that.
All right, Stephen, stay right there. Great stuff. We'll get back to you in just a second to continue this conversation. Stay with us. We'll take a look at how to use market volatility to the benefit of your portfolio right after this.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. And joining us from Calgary, he's still there, Stephen Johnston, partner with AGCAPITA Partners. Let's continue this discussion here, Stephen, and shift into gross domestic product. I'd like to know where you think it's headed and how it affects investments, but maybe just a quick 101 on how a gross domestic product is actually defined.
I mean, basically, in a nutshell, it's the sum total of all the goods and services produced in the economy. So if you want to think of it, it's basically a snapshot of every economic activity that's taking place at any one time.
So what about global growth? We are focusing on macroeconomics. We know that China is still growing a little bit below 10%. You mentioned emerging markets earlier, but the Western world is a much different story.
Yeah, and it's actually one of the core investment premises from myself and my partners is because we actually we've come out of a very benign environment for interest rates and also for growth. We've had growth basically everywhere in the world. And certainly our investment premise is that the fundamentals for sustained high levels of growth like we've had historically are not in place in the West for a number of reasons. We have high debt levels, low savings rates, we run consistent current account deficits, and we have poor demographics. We actually focus on investments that benefit from growth in the emerging economies, but do it in politically stable parts of the world. In particular, our focus is on Western Canada. When you look at the emerging economies, they actually have all the building blocks still for sustained real growth rates. They have good demographics on the whole. They have very low debt levels. They have extremely high savings rates, and they run sustained current account surpluses. So when you compare those two parts of the world, the developed world and the building blocks they have in place for growth, and the emerging markets and the building blocks they have, we look at that, and for us it really is a no-brainer. We say you want your investments to be exposed to those growth rates, but there's a little caveat there. You don't want to make direct investments in those markets, which I think the recent controversy over Sino-Forests graphically demonstrates. They have very opaque accounting. It's very difficult if you don't speak the language or understand the customs to make direct investments into emerging markets. Much better to generate those returns by investments that are linked to the growth that's taking place there. And for us, it's very simple. We focus on commodity-linked investments because obviously commodities are benefiting from the growth in the emerging economies.
So when you talk about growth in emerging economies, Stephen, you're not just talking about the GDP, but also the actual growth from a population point of view, things that central governments can't really fool around with. There are more people who are eating more food and consuming more goods and services.
You know, I mean, it's a trite observation, but I think in some ways it's always useful to bear in mind demographics are destiny. And when you have, the economy of a country which has an aging population versus a young population looks very different. And the countries with the younger demographics are heading into their high growth phases, whereas in the West, we're at the other end of that demographic curve, and we're heading into our low growth phase.
Now, Stephen, I'm wondering, in light of that, we heard the word decoupling thrown around a couple of years ago in terms of the emerging markets decoupling from the Western markets. Do you see that as being possible, or are we so inextricably linked that that's just not really a possible scenario?
You know, I would, given the nature of the global economy and the massive interdependencies between, you know, producers, suppliers, you know, people who provide capital, I think that that's probably an unrealistic expectation. But certainly the emerging economies don't demonstrate anywhere near the correlation to Western growth rates that they used to, you know, 15 years ago. You know, you look at the rates of growth and what happens during recessions in the West. You know, the old adage was, you know, the United States gets the sniffles and the emerging economy gets pneumonia, right? Well, that isn't the case anymore. You look at what's transpired in the West. You know, growth has rapidly decelerated. And yet you don't see that same effect in the emerging economies anymore. You know, they're starting to have economies that are much more self-sustaining and are not as reliant on growth in our markets to continue. So, you know, I don't think we'll ever reach a point in the world economy where people are completely decoupled, but certainly we're not at the point now where, you know, the problems that we have completely derail the emerging economy growth story.
And Stephen, if we're looking at some of those economies on their own from a secular or provincial point of view, and we see the kind of growth that you've just alluded to, do you think that it's possible for investors for whom volatility fatigue has become very real in the recent past, that they might find solace or calmer waters on foreign shores?
Yeah, I mean, one of our investment criteria is we like to focus on, we like to find investment returns that are non-volatile and as much as possible not correlated to traditional asset classes, particularly bonds and stocks. And in particular, we have a farmland fund. And one of the things that really attracted us and appealed to us as investors about farmland was that it demonstrates, the annual returns demonstrate very low volatilities. And in fact, on the order of 1/3 the volatility of the stock market. And of course, farmland is basically a derivative of agricultural commodity prices, and those in turn are being driven by the demand for food coming out of the emerging economy. So by buying farmland in Western Canada, you get a non-volatile exposure to emerging market demand for food.
Now, Stephen, I just want to ask you about the fact that we have Moody's looking at the debt rating of the United States for a possible downgrade because of the debt ceiling issue, and of course the European debt crisis continues, and hence that all ties into the possibility that we may see some extreme volatility coming up. How are you positioned for your investors?
We, as much as possible, tend to avoid leverage. And we also, as I just mentioned, we're focusing on assets that historically don't have that kind of volatility. And so we've, as much as possible, already stripped that risk out for our investors. I mean, the key thing is that what you're seeing now is, although people aren't perhaps saying it out loud, is you're seeing a solvency crisis. This isn't a liquidity crisis. This isn't a problem because these countries can't roll over debt. This is a problem because these countries are bankrupt. And I think we're going to see that expand. I mean, we don't want to be too complacent in Canada or the United States, saying, well, our debt position isn't as bad as it is in Greece. Actually, we're not that far off. And so as much as possible, I would argue, as an investor, you want to avoid markets that have a direct linkage to that kind of volatility, particularly the sovereign debt markets.
Stephen, you know, one thing that we see with a lot of these governments is that they do have huge stores of precious metals. And I brought my own prop in today. It's a 100-ounce bar of silver, which I think we can throw on the screen, which has, you want to talk about volatility, it's gone from 3,500 to 5,000 back to 3,600 in a matter of weeks. Can you explain very simply for us, why does that happen? And is silver money or is it something else?
Well, I would argue that precious metals are certainly monetary, have monetary qualities. I mean, they haven't been completely remonetized, but I mean, it's funny that we're having this discussion because up until as recently as 1971, the United States was on a gold standard. Gold was money. And gold has been money for thousands of years. So I don't think it should shock anybody who's out there and investing in a negative real interest rate environment with a lot of overhanging questions about sovereign stability in a market where the central banks have crossed the monetary Rubicon. Right. They're rapidly expanding the monetary base. That there is a lot of renewed interest in a store of value like precious metals. And so none of that should be surprising. Thanks very much, Stephen. We'll have to wrap it up there. Thanks so much for your insight today. That was great. Thank you. All right, Stephen Johnston and David Kaufman, thanks a lot. It's great. We will see you next week. Thanks for joining us on Alternative Investing. If you've got a question about alternative investments, you can email us at alternativeinvesting@bnn.ca. Thanks for watching. We'll see you next week.